Welcome to This Explainer. Today, we're unpacking Caterpillar's absolute bombshell Q2 2026 earnings report, and honestly, their explosive transformation. You know, if you think you know this legacy industrial company, well, you might need to recalibrate a bit. Because the numbers we're looking at today, they represent a literal, seismic shift in their core business model.
Okay, so let's dive right into this massive 12% single-day stock jump. I mean, a double-digit pop for an industrial giant of this size, that's incredibly rare. And it's really the ultimate proof that this company is no longer just about, selling yellow bulldozers for traditional construction. There is something much, much bigger fueling this momentum right now.
So here's our roadmap for today. First, we'll look at the earnings breakout, then the AI infrastructure trade. After that, navigating the real risks, checking in on the Wall Street consensus, and finally, the final takeaway.
Now let's kick things off with Section 1, the earnings breakout, and how they are just smashing expectations.
The sheer magnitude of this earnings beat absolutely caught everyone off guard. Wall Street estimates were sitting at $6.22, which, to be fair, was already a pretty strong expectation. But the actual reported adjusted earnings per share? It came in at $8.17. That's a massive 73% jump year over year. Seriously, when a mature company crushes estimates by nearly $2 full, it forces the entire market to completely reevaluate its growth trajectory.
And you know what? Revenue followed the exact same trajectory. Analysts had forecasted $19.3 billion, but Caterpillar just sailed right past that, hitting a record $20.5 billion. That represents a 24% increase from last year. We are seeing some incredible top-line and bottom-line expansion happening simultaneously here.
But honestly, the most staggering number hidden in this report is the 92% surge in their backlog. It now sits at an eye-watering $72.1 billion. To put that into perspective for a second, based on their current run rate, that means Caterpillar already has nearly a full year's worth of work completely booked and waiting to be fulfilled. That provides just an incredible layer of financial visibility.
So the crucial takeaway here is that management is incredibly confident. Thanks to that massive backlog and the sheer revenue momentum we just talked about, they've officially raised their full-year sales growth outlook. They were previously guiding for low double-digit growth, and they've now confidently bumped that up to the mid to high teens.
Moving right along to Section 2, the AI infrastructure trade, looking way beyond traditional construction.
Now, this right here is the secret sauce behind the huge earnings beat. Hyperscalers, massive tech giants like Amazon, Microsoft, and Google, they're building AI data centers at an absolutely record pace right now. But here's the thing, artificial intelligence doesn't just magically live in the cloud. It requires massive amounts of physical electricity to function. These tech giants desperately need Caterpillar's massive generators and industrial power systems to keep their data centers running uninterrupted. And this, my friends, is what we call the physical infrastructure trade.
You can actually see this new demand showing up directly in their segment breakdown. Construction industries saw sales surge by 35%, which is driven heavily by the physical build-outs of these massive infrastructure projects. Meanwhile, energy and transportation is up 17%, and that is driven directly by the demand for the heavy power generation needed to sustain those very same data centers.
It's a really profound shift in how we have to view this company going forward. They are no longer just some cyclical construction play tied to, say, housing or road building. No, they are now the foundational backbone for the future of artificial intelligence. It's pretty simple. If AI grows, the physical power requirements grow right along with it, and Caterpillar is positioned perfectly to capture that demand.
All right, let's turn to Section 3, navigating the real risks and the headwinds we need to watch out for.
So, to be completely objective, the three primary headwinds facing Caterpillar right now are massive tariff costs, tightening regional regulatory hurdles, and of course their vulnerability to a broader cyclical macroeconomic slowdown. Because their price-to-earnings ratio is so elevated right now from this massive stock jump, expectations are essentially priced for perfection, which means any stumble in these three areas could easily trigger a pretty sharp pullback.
Looking specifically at the regulatory landscape, we're seeing some very different approaches across states that could threaten this whole AI growth narrative. For example, New York has instituted a temporary moratorium on some data center projects due to environmental and power grid concerns. Then, down in Texas, they're actively auditing their power grid demands to see if they can even handle the incoming load. If these types of regulatory roadblocks start spreading to other states like wildfire, well, it could severely slow down the very data center demand that's currently fueling Caterpillar's explosive growth. Furthermore, we absolutely have to look at the global supply chain. The company now expects full-year tariff costs to hit roughly $2.2 billion. Now, while management has handled these costs much better than expected so far, mostly through pricing power and internal efficiencies, any further escalation in these tariffs could significantly hit their profit margins going forward.
That brings us to Section 4, Wall Street Consensus, where we see how the pros are weighing in.
Well, the bulls are out in full force, let me tell you. Truist and JP Morgan have set these massive price targets, $1,218 and $1,165 respectively, and both have issued firm buy ratings. Wells Fargo and Oppenheimer are right behind them. With the stock currently trading in the $800 to $900 range, these bulls are seeing a massive 10 to 30% upside from current levels. On the flip side, you have more cautious voices like Barclays. They believe the stock is pretty fairly valued right now, assigning it a hold rating with an $800 target.
So blending all of those professional perspectives together, the current analyst consensus sits at a moderate buy, with an average price target of just over $1,016. The street clearly believes there is still room to run here, but, they're definitely keeping one eye cautiously on the broader macroeconomic environment. Okay, let's wrap things up with Section 5, the final takeaway, and exactly what you should be watching.
So here's the bottom line for you. Caterpillar is executing brilliantly right now, and this AI data center story, it's a proven reality, definitely not just hype. That massive $72.1 billion backlog offers incredible financial visibility all the way through 2027. They remain a super high-quality name with a really solid dividend. However, because it's still fundamentally a cyclical stock, if unemployment rises or GDP slows down, stocks like Caterpillar do tend to get hit first. Long-term investors might want to keep a really close watch on the macroeconomic data, and maybe even wait for a pullback before jumping in at these newly elevated levels.
Which brings us to our final question today. We've seen that the AI revolution isn't just happening in software code. It's literally being built with heavy steel, massive generators, and billions of dollars in physical infrastructure. But with a macroeconomy kind of teetering on cyclical changes and the stock arguably priced for perfection right now, the stakes really have never been higher. So based on everything we've covered today, are you buying, holding, or selling CAT right now? Let me know. Thanks for joining me for this explainer, and I will see you next time.